Hello, everyone. Thank you for joining us for this session of Tax Insights Live. It is good to see you all. I think you all know me. I'm Sarah Gardner. I'm the founder of Allegro Tax. And for the first time today, we have a new format. And I'm joined by my colleague, Kate Reynolds, who's our Associate Tax Director, who has many years' experience in corporate M&A and shareholder matters. So will be joining me on the call. So as you know, today we're talking about pre-transaction tax planning and maximising value before the deal. So we're going to be looking at some specific risk areas, but we're going to talk first about how they tie into adding value, because today we're not just talking about avoiding risk, although that's a large part of it. We're talking about maximising value in a wider context. So very broadly, to maximise value before a deal, we need to align management with tax efficient incentives. We need to ensure shareholders qualify for all available reliefs. We need to simplify and streamline ownership structures, and we need to address tax risks early. Now, here we've said employment tax risks, but we've been reflecting actually it's not just employment tax risks, it's all tax risks, isn't it? Addressing them very, very early on. And tax planning completed early in the life cycle of a deal can significantly increase the net proceeds that shareholders actually receive, actually take home, and that's what we're talking about today, isn't it? Maximising that value in those shareholder proceeds. So before we get into the detail, we're just going to talk about why we might want to plan early. We all know that buyers undertake extensive due diligence, don't we? But the issue is that late tax planning destroys value, and so many times, I'm sure Kate will agree with me, but we see people coming to us just too late to really maximise the value. Sometimes there's just nothing we can do at a late stage to avoid or mitigate a particular issue. So late planning really can destroy value. It can cause price chips. That's the obvious one, isn't it? But also retentions and escrows, additional indemnities required by a buyer, exclusions from the warranties and indemnities insurance. It can actually cause deal failure. It can cause the deal to collapse in some circumstances, and will certainly cause delay and stress. And I'm sure we'll all agree that extra delays and extra stress is not what anybody needs at the point of a transaction. So we're going to talk about the detail of risks and how to mitigate them. But this is the broader picture as to why it matters. This is the potential impact on deal value of late tax planning. So firstly, I'm going to hand over to Kate, who's going to cover the corporate perspectives. And then I'm going to step back in later talking about people and ownership structures. So Kate, I'll hand over to you.
Fantastic. Thanks, Sarah. So for those of you who don't know me, Kate Reynolds. I've spent much of the last 25 years with initially Deloitte and then PwC, supporting and advising a range of clients, private equity backed, privately owned, heading on a journey to an exit, growing, transacting, doing M&A structures, supporting the shareholders as well as the companies. Yes, I have seen one or two of these issues crop up. And I think as you were going through there, Sarah, the list of, why do you need to get to it early? The other classic one is, people will turn up 5 minutes before a transaction and say, oh, I'd always meant to give George, my fellow, he should be my shareholder. I always meant to give him some shares and kind of never quite got round to it. Can I give him some shares now, please? To which the answer is, well, no, I'm afraid you've left it a bit too late. Yeah. So that is, another good reason for making sure that one looks at these things in good time, and well before any kind of transaction is anywhere on the horizon.
We've had a number of those, haven't we, actually, in recent months and years, actually, that exact scenario. It seems to be one that comes up time and time again.
Yeah. So in terms of corporate then, having been the annoying person doing the tax diligence and asking all those awkward questions, I know what advisors are, looking for and will expect. I would say the overall message from this side is just get the basics right. It may be fairly obvious, but make sure that you've got, a good track record of 4 to 6 years worth of tax returns filed with the tax paid on time. Do your hardest if you've got HMRC inquiries to get them closed. I won't give you, you'll be very pleased to know, a tax masterclass on what SAO, QUIPs and CCOs all stand for. For those of you who know, you'll be familiar with it. For those who don't, you want a bit more of a steer, that's fine. But essentially, senior accounting officers, if the company's big enough, they need to be making filings. quips, quarterly instalment payments, just make sure that tax is paid on time, and it can end up being paid earlier than you might expect as the company grows. CCO, corporate criminal offence, essentially that one is legislation that came in about 9 years ago. There is no penalty limit on that in a worst case scenario, so it's why it tends to come up on diligence. And make sure that your tax relief on major capex projects has been properly supported. Essentially, these core issues will be what may form the basis of the purchaser's view of the company's controlled environment. If you get these right, the impression will be, broadly speaking, you've got good controls in place, there'll be a smoother deal. If there are one or two kind of little glitches pop up, they're less likely to be troublesome if they're against the context, against the background of this basic stuff has been got right. So mitigation on that, yes, just check the above and make sure that any items outstanding are actioned. So that's that one. International. Sorry, no, Sarah, go on.
I was just going to pick up on what you just said briefly. It's interesting, there's an element of human nature, isn't there? You can't help but think if you find lots of issues that haven't been dealt with and have perhaps been swept under the carpet, you can't help but wonder what else there is, can you?
Yeah.
Whereas if it looks like everything's been, a competent person's done it, documentation's been kept, everything's been filed, you're less likely to be worried about what else is lurking, aren't you?
Indeed, it's the old halo and horns effect, isn't it? From the first interaction. So international bear traps to dodge. From a trading transactions perspective, and we'll come on to financing in a minute. Transfer pricing, the broad rules are that if you've got two companies in different countries trading with each other, then they should be trading on an arm's length basis so that each tax jurisdiction gets the right amount of tax. Documentation and analysis, the requirements get more onerous as the companies get bigger, but even at a basic level, it's always worth getting your basics right, and understanding how you are transacting with each other and why. IP management, that one is pretty important, particularly if you're the kind of business who's doing R&D offshore. So for any of the lawyers on the call, I'm not necessarily talking about anything particularly complicated, but just a simple intercompany agreement in place, which sets out that overseas may be doing R&D on behalf of UK, but UK will own the IP as a result, and will pay overseas at a, call it cost plus 5, rate for services provided. That's all we need at a starter for 10. But if you haven't even got that in place, then it looks as though you just haven't got a clue.
What would you say? What would you say, Kate, to an advisor on this call who's thinking, well, my client is too small for transfer pricing. I can tick that box. They're too small. Can they just put whatever charges in place they see fit or that work commercially, or do they still need to be thinking about the arm's length basis?
I think there are two aspects to that, Sarah, and it's an interesting question. One is that just because the UK-led jurisdictions don't worry about size, or say that if you're small, you don't need to worry so much. Not all overseas jurisdictions will say the same. And so just because you may not be at risk of an inquiry in the UK, do you really want to be at risk of inquiry in foreign territories? In some ways, that's almost worse. The other point to be aware of is that I had one client a few years ago who thought it was a great idea. I think he was based in Dubai with a company trading in the UK, and his plan was to pay a management charge back to his Dubai entity that would suck all of the profits out of the UK, leaving the UK with no profits at all subject to tax, and bringing all of the profits out to his Dubai entity, paying no tax over there either. And that would be splendid, wouldn't it? To which the answer is, well, from a, wholly and exclusively, is it on basic principles an allowable payment? And if it's not a basic allowable payment from a tax perspective, then the fact it's with an overseas entity that's a related party means that it simply won't be deductible. So you can end up with inquiries, penalties, additional tax arising, and it just looks fishy, frankly. You're far better off if you're preparing for diligence to have something sensible and commercial in place.
Yeah. Thank you.
PE, permanent establishment, and residence risks. If you've got people flying around the world, then just be mindful of the fact that they can end up creating tax presence where they're physically doing business. It's not just these days about where the contract is actually signed. If you're significantly involved in negotiating a contract in one territory that brings that contract to an ultimate conclusion, then the chances are, with today's definitions of permanent establishment, then you will have created a PE overseas. So just be mindful of that one, aware of where your people are, map them, think about it, document the risk. The last one I've got down here, US sales tax, state and local, they are a potentially very costly minefield. I've seen a few transactions over the years where people have been new to the US market, haven't really understood how the sales tax regime works. It's a bit like our VAT regime, but it's different. And you need to get all of your paperwork in place right at the start. Otherwise, you can end up with sopping great tax exposures. And because it's a tax which is based on turnover, not profit, the numbers can ramp up really very quickly. If you don't get this lot right, exit charges, double taxation, interest and penalties, long-running foreign tax audits. Some jurisdictions do actually have criminal charges for tax offences against the directors. So yes, you don't want to take that too lightly. Ultimately, it's an easy target for a price chip. If you've got a purchaser who is looking for an excuse to knock away at the price, if you've got some issues in this area, then that gives them, a reason to say that the business is worth less than you would like them to pay you for it. So that's that slide. Moving on to the next one, financing. What are the things to watch out for here? If you've got a UK company trading in sterling and then an overseas company, let's say trading in dollars, and you make a loan from UK to overseas, is that loan sterling dominated or is that loan dollar denominated? Whichever one it is, you're going to have FX popping up in the other one. So just thinking about that, thinking about where you want to manage that FX from, and making sure that you understand what the tax implications will be of that FX fluctuation. It may be a balance between two group companies, but it can still throw off cash tax costs in the UK or overseas. Withholding tax obligations. I've had clients both with Australian, various other foreign subsidiaries paying tax to the UK, paying interest to the UK, not realising the withholding obligations and exposures. And if you've got a withholding obligation out of the UK, make sure that you are making the relevant filings in the to HMRC, and go for treaty clearance early where you can. Thin cap analysis is a fancy tax word for basically saying, is the interest arm's length? Would a third party bank lend you this much? And would a third party bank charge you this interest rate? Debt pushdowns, that's probably getting a little bit too exciting, but in broad terms, you're looking to say, if you've borrowed in the UK to fund an overseas purchase, have you got capacity to use all of the interest expenses in the UK, or would you actually quite like to get tax relief overseas? That interest expense, you need to do a bit of structuring in good time, and kind of manage that sensibly, if that's what you would like. Late paid interest rules, essentially, if you've got shareholder debt and you are accruing but not paying the interest on that, then it is likely that your tax relief on the UK company will be available on a paid, not an accruals basis. Issuing a payment in kind note, a PIK note, constitutes payment. That will trigger a withholding obligation depending upon the situation of the lender. But don't PIK without checking with a note holder first. I had one client who did that a few years ago, FD of a PE-backed group, picked a bunch of notes from a shareholder loan because he wanted the tax relief in his UK trader, and didn't realise that he was going to be creating a whole bunch of dry tax charges. basically on the investors in the fund because of the way the fund was structured. It's the only time I've seen an FD get fired for doing something from a tax perspective without getting his advice in place first. So yes, just make sure that you understand the implications on both ends if you are going to be picking. If you don't manage this lot, double taxation, withholding tax leakage, tax cash flows that don't match the financing cash flows, that's back to the withholding point. Dry tax charge to the investors I've talked about. Overseas tax audits, interest and penalties. And again, it's another easy target for a price chip. So it's just creating pain for yourself that you don't want to have, managing it in good time and making sure that it all looks as though you know what you're doing is all the sensible way to go here. So that's the financing arrangements. Losses. I've also said it's all in the story. I think the starter for 10 and the expectation should always be on exit. If you've got losses carried forward, a purchaser will very rarely be willing to pay value for those losses. So if you want to realise any value for your losses, you as the vendor need to have a really good story ready as to why they are actually going to be valuable. And I would suggest that you think up front about a number of points and go into any negotiations ready to articulate why won't the UK change of ownership and the loss restriction rules apply here? Are they really good losses? How quickly are they going to get used post completion? What are your plans looking like as the business ramps up? The impact of being part of a bigger group on completion. I think for advisors on the call, I would say manage clients' expectations. So if vendors don't expect to realise any value for the losses, then anything they do get is bonus. But I'd also say it can be quite a useful tool in a wider negotiation on deal value. If you've gone in saying, well, I've got £1 million worth of losses here, so I'd like 250 grand's worth of value for my deferred tax asset. The other side push back, and then something else comes up that you actually care about more. You might then ultimately be willing to concede on the losses in order to negotiate to gain something else that you think is potentially more valuable. So view it in the round, but fundamentally don't expect your losses to have value, but at the same time have a good go at getting some value for them where you can. So that's your losses. R&D tax relief. Now, why does this one matter? It's a real shame, but there have been, sadly, a few bad actors in the field over the last few years, raising the risk profile of this for everybody, which means that for all of those businesses who've taken sensible advice, who've got their documentation properly sorted, and who, are not trying to make claims that are, just blown up out of proportion or for, claims that don't have any basis, they too are, meaning it's become a key area of HMRC focus, and as a result it's become a key area of focus from a diligence perspective as well. So making sure that your R&D claims have been properly supported is really important. Again, you've got a price chip risk as well as HMRC interest and penalties. You really don't want an open HMRC inquiry on your R&D claims because from a purchaser perspective, they'll just assume that all of the claim is invalid and expect that kind of repayment will be due with interest and penalties. If you have any concerns about R&D claims to be made historically, then it might not be a bad shout to, depending upon your relationship with whoever advised on those R&D claims, if you are still in a good relationship and you trust them, just, make sure they're comfortable. If for any reason you've parted ways or you have any concerns, maybe get somebody else that you trust to do a second review and make sure that they're comfortable with the historic claims that you've made. So that, I think, Sarah, did you have any further thoughts on R&D?
I don't think anything specific to add, but I just completely agree that it's worth getting a second opinion. This is a much higher risk area than it ever has been. And one of the issues with HMRC's approach is if it's a loss-making claim where there's a repayment due. It's pay now and then investigate later. So it can be quite a difficult situation if the advisor has disappeared, because a lot of them have closed down. So I definitely agree with your point around, well, dealing with it early, well in advance of the deal, which is the whole point of today's call, but also getting a second opinion. And we do have an R&D specialist on our team, Will, who is able to look at these claims and say, yes, I think that this would have qualified if we'd looked at it in the first place, or actually I think there is an issue that we would need to deal with in order to prevent you having a problem at the point of sale. So do get in touch if you'd like us to arrange for you to speak to our specialist on that.
Fantastic, thanks. So just to wrap up from the corporate perspective, then I think uncertainty on diligence is expensive. I think that's the kind of the key message to be aware of. Essentially, if I'm going in and diligencing a business, if there is a risk which may or may not come to pass, what I would always advise the client who's a purchaser is, well, in a worst case scenario, the number on this would be X, and I would estimate the worst case, because that is what could happen. Then what's the worst case on penalties? Then add some interest onto that, and that will be the number that I have to tell my purchaser client is the potential value of that uncertainty, and that will be their starting point on negotiation in terms of whether it's price chips or whatever. If you as the company have dealt with this up front, potentially proactively agreed with HMRC, go on to HMRC and said, look, I'm concerned about my R&D claim from a couple of years ago. Actually, I think the number should be slightly different, offer to pay a little bit of tax, get their explicit agreement that everything's now good. You have dealt with that uncertainty. You've got explicit agreement, and you can go into your diligence with it costing you a whole lot less than it otherwise might do. As I said at the start, getting the basics right demonstrates a strong control environment. That's valuable in terms of the overall impression that the purchaser is going to gain of the company. Tax may be below the line, but I said, tax, don't forget, tax equals cash equals value on exit. So just because it's not part of the EBITDA multiple, it can still drive value quite definitely. And don't forget as well, some taxes are actually above the line, so they do get the multiplier effect that drive EV. So things like VAT, things like payroll taxes, they're all above the line. They contribute to EBITDA. So if you are managing those sensibly and optimizing your tax costs there, then you've got your multiplier effect on increasing value in due course. Likewise, if a diligence identifies a whole bunch of VAT risks, then again, that potentially goes to the maintainable EBITDA when you're negotiating overall deal value. And if you wait for DD to identify the risks, it will be too late to fix them. You're never going to get agreement with HMRC in the space of time that a deal timetable that you're working to. So at that point, you're going to be going into a transaction with uncertainty over whether or not these risks are actually got basis or not. So on that cheery note, I will hand over to Sarah to talk about the more exciting topic of employee incentives.
Thank you, Kate. That was really useful. And what's really struck me as you've been speaking is how much of the matters that you were talking about relate to uncertainty and lack of clarity, and the impact that has. Because as you said, the advisor doing the due diligence for the buyer is always going to look at the worst case scenario. That's their job. That's what they have to do. So that, and there's a very obvious impact on deal value there, isn't there? So is looking at these things 2, 3, maybe even more years in advance of the deal, isn't it, to iron them out, so there's as little uncertainty and as much clarity as possible when they get to the deal. I was really struck by how much everything you said came back to that, so thank you.
No, it's why something like a tax clearance or getting a EMI valuation done and so on is just so valuable, because it's HMRC giving explicit sign off on something, which just gives you complete comfort. And that is actually really, really valuable to stick in a data room, that clearance, that HMRC agreement. Yeah,
thank you. Right, so I'm going to move on now to look at the more some of the employee issues. So taking a broader look, when buyers are thinking about value, what do they want in this respect? They want management who are aligned with the transaction. They want the key people retained post deal, and we've all seen these negotiations about deferred considerations and tie-ins and earn-outs and so on. Obviously, they don't want any unexpected tax liabilities. That's the worst case scenario, isn't it? But importantly, they also want incentives that don't distort valuation. And tying all that together, they want, as we've just said, they want certainty and clarity, don't they? So when it comes to incentives, badly structured incentives can trigger unexpected employment taxes, can create disputes, whether that's tax disputes or disputes between individuals in the business, and ultimately reduce the proceeds to the sellers, because if there's an error in the implementation of an incentive, which means that sellers are getting income tax rates up to 45%, potentially plus national insurance contributions, where they thought they were going to be paying much lower rates of capital gains tax, potentially a huge impact on the value that they receive. So in terms of how to build the value, take careful advice on careful implementation of the common structures. And we're going to look at each of those in a moment, but some of the most common ones that we see are EMI options, growth shares, transaction bonuses, and retention incentives. So we'll look at both of those, or all of those in turn. So EMI share options, we advise on these very, very often. We've taken on about 3 new ones in the last week or so. It's a large part of our work. And the risk, if it's not done properly, is that actually the options can be not qualifying for EMI at all. So whereas people thought they were going to get capital gains tax treatment on eventual sale of the shares, they might actually have income tax at 45%, obviously far higher than they were expecting. One of the benefits of EMI, as well as allowing option holders to essentially lock in today's market value as their exercise price in the future, even if the company's increased in value. Another benefit is that when they sell, whereas normally to get business asset disposal relief, which is the best rate of corporation tax on a sale, normally you have to have 5% of the shares in the company. If you get your shares through EMI, you don't have to have that 5% rule. And at the moment, the business asset disposal relief rate is 14%, going up to 18% in April. But the main rate is 24%. So at the moment, there's a difference between potentially being taxed at 14% business asset disposal relief versus your income tax rate, if it's done wrong, 40 or 45%, potentially huge tax difference. Very specific risks in terms of EMI claims is, I think we've got an error on our slide there, we've got R&D relief, which obviously shouldn't be there. Interest and penalties following HMRC challenge. So HMRC, the scheme wasn't appropriately or properly implemented, and raising issues and potentially even saying that the options don't qualify under EMI. In terms of how to build value, we need to grant options well before sale discussions. We need to agree the valuation with HMRC. One of the great benefits of EMI is that you can agree the valuation up front with HMRC, whereas with other share incentives, you can't. So that is one of the great benefits. Agree the valuation up front with HMRC and confirm the company actually qualifies. So we often complete an advance assurance for a company, which will ask HMRC to confirm they believe the company qualifies to issue shares under the EMI scheme. And often on due diligence, eventually that's quite helpful because the buyer can see that HMRC were happy the company qualified to issue options under the EMI scheme. Another key area is registering the options in time. If options aren't registered by the deadline, then they won't qualify for EMI, and people won't get the expected tax benefits. So the rule at the moment is that options have to be notified to HMRC by the 6th of July following the end of the tax year in which they were issued. It used to be within 92 days. So you might, if you read something online or you've done this in the past, you might have 92 days in your mind. Actually, now it's the 6th of July following the end of the tax year in which the options were granted. So some key points around EMI: make sure it's set up properly, make sure the company qualifies, agree the valuation with HMRC, and make sure they're notified in time. And as I say, the obvious deal value erosion is if people aren't getting capital gains tax treatment, but instead getting income tax treatment.
It's interesting as you were talking about that, Sarah. I've got a client at the moment. It's a live issue. They put an EMI plan in last year, and they're now doing a restructuring to pop a new holding company on top of the trader, which I think is something that a number of businesses might do for a whole variety of reasons. they hadn't taken proper holistic advice, just came to us for a bit of help with the clearance. But in the course of conversation, I discovered that they'd issued EMI options last year, and they didn't realise that if they put a new holdco on top, those EMI options no longer qualify for EMI. As an easy solution, which is you roll them up to the new holdco, so that they're options over the shares of the new holdco. But if they, if clients don't take that advice and don't realise that, the act of putting a later share for share in place, putting a holdco on top, can essentially invalidate those EMI options. If we hadn't picked that up, there would have been a group of very unhappy management employees down the tracks, as you say, because they'll be down for tax at 45% or whatever, as opposed to 16%.
Yeah, it's so interesting, isn't it? There's so many things that come out of this, aren't there? One of them is the challenge when people ask us for advice piecemeal, and as you've obviously identified that issue, but there is a risk that we or another advisor might not, if we're only asked to look at a very specific area, we're not given all the information. So of course that's partly about us asking the right questions, isn't it? But the other thing is, I say to people so often with EMI and also things like EIS, so many things where the concept is really, really simple, isn't it? It's not difficult to understand what these things are trying to achieve, but the legislation behind them is not always straightforward. People might read an article about EMI and understand what it does, but they won't necessarily realise the point you've raised around if you put in a holding company, that causes a problem which needs to be dealt with. So it's interesting, isn't it?
Yeah, indeed.
So next we'll talk about growth shares. So these are commonly used when a company doesn't qualify for EMI. So perhaps its trade isn't an acceptable trade fit for EMI because there is a list of non-qualifying trades. But they're sometimes used when shareholders wish to ring fence current value. So we see this quite often where founders have spent years building up a business. They're bringing somebody else in and they want to give them some equity, but they want to ring fence the value they built up so far for themselves. So in that scenario, we will have obviously a very simple example, but their shares might be reclassified as A shares. The new individual will get B shares, and the articles of the company will say that when the company is sold, the first, say, £1 million is attributable only to the A shareholders and not to the Bs, so it can ring fence value. So we commonly see those in those two scenarios. Other reasons as well, but those are the main ones. In terms of risk here, it's quite a lot to unpick with growth shares because they can be very complex. One of the issues is that you can't agree the valuation of them with HMRC. So whereas we just said that with EMI you can, with growth shares, unless they're growth shares under an EMI scheme, if they're just growth shares, you can't. So there is no mechanism to go to HMRC and ask them to sign off on that value. So of course, incorrect valuation is an issue. So come to somebody like us, an independent professional valuer, to actually do the valuation exercise, even if it's not going to be submitted to HMRC, just so that you've got that in the future to rely on if HMRC were to challenge the value of the shares.
It's always having that available to stick into a data room. If you look ahead to you're doing this on diligence, purchaser comes along and says, well, why did you decide that was the right value of the shares? If you've got an independent valuation, it just goes such a long way to getting them comfortable and they move on to the next question. Yeah, exactly. It shows again, shows they were aware of potential issues, shows they've taken it seriously, shows they've taken advice, doesn't it? It's lots of benefits. The other issue we see with growth shares is poorly drafted share rights. And I gave my simplistic example of, a situation where, a company's articles might say that the A shareholders benefit from the first £1 million of proceeds on a sale, and then the B shareholders participate thereafter. But obviously in these scenarios, it can be very complex, and you'll have, several classes of growth shares. Perhaps they participate for different values, different percentages. There might be some performance criteria. It can be very complex. So poorly drafted share rights is a potentially huge issue. Firstly, in terms of tax value, which is what we're talking about today, but also in terms of creating disputes if somebody isn't getting what they thought they were going to get at the point of the exit. So always ensure that legal advice is taken early so those share rights are properly and correctly drafted. Completion bonuses. I mean, we see this quite often. As Kate said right at the beginning, we see the situation very frequently where people say, they've built a business over many years. They promised somebody, 10% of the shares, say at an early stage. Everyone was so busy, as founders are,
they just didn't get round to doing it. So they say, you know, at the end, can we either give them the shares or can we just give them a bonus of the equivalent amount? It is common, but the problem is these bonuses are just taxed like any other bonus, you know, that a business might pay. So they incur income tax, employers' national insurance, employees' national insurance. They're tax inefficient. So if somebody's going to receive a bonus, but then they're going to have 45% tax plus national insurance contributions deducted from it, obviously the value they realise is far less than the headline amount of the bonus. They also don't necessarily align management goals with founders, because if somebody knows they're going to be getting a bonus, they don't necessarily need to build the value of the business. Whereas if they're benefiting from a share sale, obviously the higher the value of the shares, you know, the more they're going to end up with in terms of proceeds. So there are issues with completion bonuses. We would suggest, and again, we're talking here, we can't, this is not for the point of the deal, but from an early stage, consider equity incentives, which reduce tax leakage, and also importantly align management with founders, so everybody is working towards that common goal. If you decide at the point of a sale you want to give somebody shares, that's not going to be very tax efficient, because essentially they will be taxed on the value they receive, and of course the value has been set by them because as a buyer. This needs to be done early on. So although completion bonuses are very common, then not tax efficient, they don't align management goals. So as part of the early stage planning, we would suggest equity incentives should be seriously considered.
Well, one of the other aspects of completion bonuses that I've seen trip businesses up before, Sarah, I don't know about you, is that there tends to be a working assumption that if it's a bonus, then it'll be deductible for corporation tax purposes. But coming back to that point earlier, you know, to get a CT deduction, that something needs to be wholly and exclusively for the purposes of the company's trade. Now, if you're giving somebody a bonus because the shareholders sold their shares, that's nothing to do with the trade of the company. That's all to do with the shareholders. If you give somebody a bonus which says, thanks ever so hard, George and Georgina, for growing the business and, you know, making it really valuable and working really hard and everything else over the last few years. Really appreciate all your efforts. You know, the business has done tremendously well. That is linked to the trade of the business, and that would be deductible. And I've helped clients before now get the wording right, and it can be such a simple thing, you know, in the comms, in the email message where you send somebody saying, I'm going to pay you a bonus, just articulating the why. Everybody knows it's to do with the transaction, but if you articulate it carefully, you can support getting a CT deduction. If you don't articulate it carefully, then you can end up with no CT deduction, and that's worth, you know, 25% cash. And again, that goes straight to deal value as well.
That's a good point. That's a potentially huge issue, isn't it? I mean, the classic is when you see wording of bonuses saying, you know, if we sell for 5 million, you'll get X. If we sell for 7.5 million, you'll get Y. It's that sort of tying it to the deal, isn't it? Which is problematic. Whereas, as you say, if you say, thank you so much for all your hard work over all the years, it's tied in, isn't it, to the trade of the business. So it's all in the drafting. Another one that's all in the drafting, isn't it?
Absolutely.
So next we're going to talk about employment taxes. So common issues here, and this comes up all the time on due diligence. Consultants who should be employees, historic PAYE failures. These people should have been taxed under PAYE. It should have been deducted and paid over to HMRC along with national insurance contributions. If that wasn't done, you know, potentially huge issues can go back years, you know, with multiple employees. So this could be really significant. Unreported benefits, again, you know, if these haven't been reported to HMRC and the appropriate tax and national insurance contributions paid, potentially huge issue when we come to the point of sale. As we said at the beginning, tax indemnities, we see this all the time, escrow retentions, price chips. And the problem with this is, you know, as we've alluded to several times now, a buyer's due diligence advisor is going to look at the worst case scenario. They're going to potentially say, well, you know, you had 20 people, they should all be employees, you know, on the books for however many years. They're going to look at the full picture. They're going to look at the worst case scenario. So potentially a huge exposure there. So the value there, so how to build value there. Looking at this, well, firstly, when you take on an individual, you know, don't just let them be a contractor and gradually they build up and up and up till they're full time and essentially an employee. If you think there might be an issue, obviously don't sweep it under the carpet. Look at it, what we're talking about, sort of a runway to 2-3 years today, aren't we? Look at it in advance and sort the problem out, regularise any historic issues, so that even if there was an issue, when it does come to the deal further down the line, you can say to the due diligence team that when the buyers ask the question, yes, there was an issue, but we've dealt with it. Here's HMRC sign off. We've agreed at all with them. It's been dealt with. I think another really important one here is ensuring reality matches the paperwork, because we see this quite often. Kate's laughing. It sounds like it's not. People say, well, it's fine because the contract says, contract is essentially an ideal contract for a contractor, for a non-employee. But the reality is not that. That's not what's happening. If there are very strict criteria that you can have a look at to see if HMRC would deem somebody for tax purposes to be an employee or not. And if those criteria are not being met, despite what the paperwork says, the risk remains. So I think it's ensuring reality matches the paperwork is really, really important in this case.
I think the other piece is an interesting one. I saw on diligence. I was supporting the vendors on this occasion a few years ago, and they got a bunch of consultants, and they'd had a third party come in and review all the contracts and run the third party's tool to see whether or not they were contractors or should be employed, and they had a proper reports. They'd taken sensible advice and all the rest of it. But when I can't remember, it was a Big Four that was doing the diligence. Because they hadn't used HMRC's CEST tool, the check employment status tool, and therefore there was a question as to whether, had the CEST tool been run on these contractors, would it have spat out the same answer as whatever tool it was that these independent consultants had used. Therefore, those on doing diligence said, well, because you haven't used the CEST tool, therefore we've got to assume that there's an issue here. And so they're then stuck on an assumption of a potential, what's the tax, what's the NIC, what's the penalties and all the rest of it. Simply, even though somebody had taken sensible advice, simply because they hadn't used the CEST tool. Flip side of that, I was doing diligence a couple of months ago on a business where they had got it. They'd got their CEST tool printouts. They pop them into the data room. And for me, that's great. I kind of do a check. I match it to a contract to make sure that the answers in the CEST tool, match what was in the contract. Asked all the questions, as Sarah says, to ensure reality matched the paperwork, and that is genuinely what they were doing. And it's all good. So again, it's not just what you're doing. It's having thinking ahead to what am I going to put in the data room? What's going to help me on diligence?
It's interesting. Thanks, Kate. For those who don't know, the CEST tool is an HMRC tool. It's available online where you answer questions and it will say whether, for tax purposes, the individual should be treated as an employee. It's controversial. Some specialists believe that it doesn't give sufficient weight to the most important factors. So there is, it's not completely foolproof. There are different schools of thought about it, but it is a useful tool, and certainly, as Kate says, to have that then downloaded on file can be really, really helpful. So I'm going to talk about shareholder structure next. And again, we look at the bigger picture. What do our buyers want to see? They want to see a clear cap table. They don't want to see endless share classes with very fiddly and perhaps unclear rights. And they want the ability to acquire 100% of the company. They want to make sure that if there are minority shareholders, they have to sell if the majority shareholders make the decision to do so. The situation crops up very often where founders have started off and they have given lots of friends, family, perhaps advisors, a small amount of equity. So they've got a very messy cap table with lots and lots of minority shareholders on it. And when you get either a more sophisticated, larger investor later down the line, or at the point of sale, that can be problematic. So we always say, say to founders, really consider. We're not going to say don't give anybody any equity, because it's lots of people do a friends and family round, don't they? It's a good way of getting money in. Just be mindful of how you're doing it. Don't give it to absolutely everybody. Get advice on the structure, and make sure that you retain the ability to decide to sell the company. And everybody else has to go along with that. Quite standard, we colloquially call dragon tag rights, very common, but do just make sure that they are there. In terms of issues that can cause problems in terms of deal value, as I say, multiple historic share issues, missing shareholder agreements, if there's uncertainty over whether shareholders are required to sell can be a problem. And if you've got the situation where your articles, the shareholders agreement, or any other document that's been agreed gives minority shareholders the ability to block a sale, that is a problem. I mean, nobody wants to buy 98% of a company, do they? Buyers are going to want to buy the whole thing. So these issues are tricky because they tend to arise because of early stage decisions. And obviously, we all know businesses at early stage don't have much cash to pay for a huge amount of advice, do they? But again, if it transpires later down the line that these issues do exist, deal with them. We help people to deal with minority shareholders, share rights, and so on. So in terms of building value, always have a shareholders agreement, take early legal advice, and then if an issue does arise, as we've said with everything else today, deal with it early on so it doesn't come to the point of the sale, and then there's all these kind of fiddly minority shareholders that have to be dealt with at the time. So my final point is around business asset disposal relief. So as I mentioned earlier, and a lot of you will be aware of this, it used to be called entrepreneurs relief. It is essentially the best rate of capital gains tax. So you can pay capital gains tax at currently 14%, going up to 18% in a couple of weeks' time on the first £1 million of qualifying gains in your lifetime as an individual. And in this scenario, we're talking about selling shares. There are other categories. We're not going to go into that today, but we're talking about selling shares in a business today. And it is one of the most valuable reliefs available to entrepreneurs. But there are criteria to be met. And the problem with this is that everybody always just assumes that they will qualify. Not lots of founders do. Certainly if it's a sole founder or a small number of founders, it's fairly uncomplicated. They're very likely to, but not necessarily. So there's a minimum shareholding requirement. So as I said earlier, there is a requirement that they have to have 5% of the shares, unless they've got the shares through EMI, in which case they don't. But otherwise, they do need to have 5% as a share capital. And there are some very specific wordings around, kind of voting rights and proceeds on a sale. But broadly speaking, they have to have 5% of the shares. They have to be an officer or employee of the company at the time of the share sale. And we see frequently, I had one very recently actually, where there'd been a dispute. Somebody had resigned as an employee and director and left still holding their shares. And the problem then, of course, is that by the time they come to sell the shares, they're not an officer or employee anymore. So that is a problem. In fact, it's a terminal problem for bad relief. And there is a minimum holding period. All the criteria have to be met for at least 2 years leading up to the date of the disposal. So again, that's why we talk about this sort of 2 to 3 year runway really to maximise the value in this respect. Common complications are the 2 year holding period not being met. I had one a couple of years ago, and it was something like 1 year and 11 months or something like that. So we just advised them to wait, and obviously commercially that wouldn't always be possible. But in this scenario, it was, so they just had to wait to do the deal until the 2 years had ticked over. But also the rights attaching to shares don't meet criteria. There can be a problem here with the growth shares that we talked about earlier, because, as I say, individuals do have to be entitled to 5% of the proceeds on selling of the company. So if they've got growth shares, that might not be the case. So again, I'm not going to go down a rabbit hole with that right now, but you can see that, again, another one where the concept is very simple, but actually the interactions of different structures and different tax issues can mean it's not always as simple as it first appears. So in terms of how to build the value, confirm shareholders qualify early, look at the shareholdings. There's also a point around maximising relief. So husbands and wives, if one of them owns the business, it sometimes is worth them thinking about transferring some shares to their husband or wife or civil partner so that they can qualify for or take advantage of both of their bad relief allocations, that £1 million in a lifetime on the sale. And this often works well because husbands and wives and civil partners can transfer shares between themselves with no capital gains tax. So it can be a very tax efficient thing to do. But the second individual would still have to meet the 2 year requirement. So again, can't be done, the day before the deal. And in terms of building value, review the share classes, review the voting rights, get a lawyer or a tax advisor to have a look at the share classes, who's got what, and just make sure that everybody who thinks they're getting bad relief actually is going to get bad relief. So we do see lots of issues around this. Another common one actually is dilution. So it was all set up in a certain way that everybody, had at least the 5%. It all was good. But then later down the line, more shares have been issued. That means people have been diluted below that 5%, perhaps even without really quite realising what's happened. And obviously that's then a problem because they haven't got the 5% at the point of the sale. So really important here. I would say one of the ones that comes up the most, I think the two issues I would say come up most often are the dilution point. So look at what you're doing along the life of the business to make sure shareholders are going to get the maximum value by being eligible for bad relief. And yeah, the point around that people who walk away, certainly if there's been a dispute, people walking away, resigning as an officer or an employee of the company and not realising that means that they've immediately increased their tax on a sale. So just to draw everything back together, this is the same slide that we had at the beginning. So hopefully you can see today that we've talked about some very specific areas and we haven't gone into quite a lot of detail on some of them. But that's because the broader picture is that tax equals cash, which equals deal value. So if these issues aren't dealt with early on, there isn't always a good way to deal with them at the point of the sale. So it's that point around tax planning completed early in the life cycle can significantly increase the net proceeds that shareholders receive. So that's the key takeaway here is these areas that we've talked about. Yes, they are very specific, they are very tax detailed, but the impact on deal value is potentially huge. So really important that they're looked at as early as possible. We're happy to take any questions if anybody would like to put any in the chat. In the meantime, our contact details are here. We're both active on LinkedIn, so there's our LinkedIn and our email addresses are on here. We always like to have feedback about these sessions. Obviously, it's really good to know what you thought about the session, what you've found helpful, if there's anything you'd like us to do differently, or if you have any suggestions for future sessions. It's always really good to have suggestions for our listeners so that we can make these as relevant and helpful to you as possible. So we haven't had any questions in the chat. So unless anybody wants to put anything in just at the last minute, no, I don't think we do. If you have questions but you prefer not to put them in the chat, please do feel free to email one or both of us, and we'll be very happy to come back to you. So just want to say thank you for listening to this Tax Insights Live. We hope you found it useful, and we look forward to seeing you again next month. Thank you.